I won't sit here and tell you that everything is okay if you purchased gold for more than $5,000 or silver for more than $90. It's not okay. You may have lost a lot of money. And when you open your portfolio and find red everywhere, that heaviness and queasy feeling in your stomach is true. I am aware of that. I sense it. Furthermore, I won't belittle you by acting as though it doesn't hurt. The price of gold rose from $5,600 to $4,900. In some instances, silver went from 21 to 75 in a matter of days. These figures are not negligible. And now you hear the same thing from every financial expert, every headline, and every comment section. You were foolish. There was a bubble. You ought to have been more aware. Before things worsen, sell what is left. That's precisely what I want to discuss today. Because in my opinion, the voices, gurus, and headlines encouraging you to sell now are incorrect. Some of them, I believe, are aware that they are mistaken. And I'll demonstrate why I think that. However, I will also be forthright about the dangers. Because anyone who claims to know exactly where silver and gold are headed next is deceiving you. I'm not sure. No one is aware. I can only show you the current state of the data and let you decide for yourself. This video is just that. Context of the data. Take what is helpful and leave the rest, in my honest view. Greetings from the hidden economy. Hit subscribe if you're new here. For weeks, I have been reporting on this metal tale, and I have yet to be proven incorrect. Although my track record is available for you to review, that does not imply that I will not eventually be mistaken. I want to let you know that I only have one channel, which is the hidden economy, and that all of my videos are still there. When everyone was buying and celebrating when silver was at $117, as if nothing could go wrong. I posted a video on this channel alerting viewers about the possibility of a major crash. 117. I explained to you why the circumstances were favorable for a violent retreat, why the arrangement was risky, and why the leverage was excessive. Everyone was at ease, people were purchasing, no one was interested in listening to it. Then, in a matter of days, silver rose from 121 to 64, just as I had warned. I'm not boasting when I say this. I mention this to let you know that I have earned the right to be heard when I speak to you now. Not everyone at the top was cheering, including myself. It was me who warned you to exercise caution. I am going to tell you something different now. This crash is an opportunity, I tell you. So perhaps, listen to me. And since this is what I do here, if you're sitting there feeling terrified and unsure of what to do or whom to trust, join my channel right away. I actually make sense when I break down gold and silver. Nothing but facts, context, and frank analysis. No hype or naive optimism. You can still view every video I've created on this channel. In addition to gold and silver, I also own mining equities. This isn't financial guidance. I'm sharing what I'm seeing and doing with my personal funds here. I'll tell you something now. Gold plummeted from nearly $1,000 to $680 in 2008. 32% decline. The identical thing was stated in every headline. Gold is finished. The safe refuge is no more. People made sales. 3 years later, gold was worth $1,900. Imagine the sensation of that. Observing it rise to $1,900 while selling at $680. Next, $2,000, then $3,000, then $5,000. It was yours. It was yours. And you gave it away because you were scared. Silver fell to $12 at the beginning of COVID in 2020. 12. People sold in a panic. Silver was at 30 in 18 months. Since they didn't sell, those who held at 12 are currently enjoying 600% gains. And here we are once more. Gold fell 21% from its highest point. Silver fell 41%. Silver had its worst day since 1980. The same voices that spoke in 2008 and 2020 are speaking again. It's finished. Sell, proceed. History doesn't have to happen again. Perhaps this time is different. Perhaps the crash goes on. Gold might reach 4,000. Silver might reach 50. I can't rule that out, and anyone does isn't telling the truth to you. However, I can tell you that the Earth looked exactly like this the last 2 occasions. The worst thing you could have done was to sell. And for the same reasons that made it the worst choice back then, I believe it could be the worst choice right now. I'll demonstrate what I mean. Initially, I would like you to view a chart that is unrelated to gold or silver. This is a 140-year chart of the U.S. stock market. In particular, the Shiller PE ratio. Don't stress over the name. It just gauges how costly stocks are in comparison to real earnings for businesses. The more overvalued the stocks, the higher the figure. That number is 40.58 at the moment. It has only been higher than this twice in 140 years. 1929 was the first time. Do you know what came next? The second instance occurred in 2000, just prior to the dot-com bust. Only twice throughout your great-grandparents' lifetimes were equities more costly than they are now. Why is this important for silver and gold? Because money poured into gold both times after stocks plummeted from those high levels. The value of gold increased sevenfold following the dot-com crash. Gold roughly tripled after 2008. It's a straightforward pattern. Something finally gives when equities are this costly. People run to the item that has been valuable for thousands of years when it gives. I won't tell you that tomorrow is going to be a stock market meltdown. I'm telling you that the conditions, the setup, and the environment are exactly the same as the two worst stock market eras in contemporary history. And historically, gold and silver have been the best, not the worst, places to be in that setting. This is when it becomes personal. You fear that the price of gold will fall from $5,600 to $4,900. Do you, however, have the same concerns about a stock market that is more costly than it was before to the Great Depression? A correction in a bull market is one example. A possible collapse of generations is the other. Determine which of these the media wants you to focus on and why. 3 days ago, the second item I want you to see was released. It's Reuters, not just any blog. Chinese regulators are instructing its banks to cut back on U.S. government bond holdings in order to restrict fresh acquisitions and pare down positions, according to Reuters. The cause is worries about the creditworthiness of the U.S. Give it a moment to land. The world's second-largest economy no longer has faith in U.S. government debt. And they're not trying to hide it. On the record, they are advising their banks to come out publicly. What happens to that money? What happens to U.S. bonds worth billions that China sells? It turns into gold, according to history. For many years, China has been the largest buyer of gold by central banks. They're speeding up now. It's becoming a policy. China is deliberately shifting its national reserves into the same asset class that we possess, while you and I sit here watching our gold portfolio decline and questioning whether we made a mistake. Think about that for a moment. And China isn't the only country involved. Countries all over the world are becoming hesitant to own U.S. assets as a result of Trump's trade policies, pressure on the Federal Reserve, and tariff threats. Market players are specifically challenging the U.S. debt's haven reputation, according to the Reuters piece. The haven status is a quote. Crypto is not a suitable substitute when the world's safe haven asset begins to lose its repute. Stocks aren't it. It's worth gold. For 5,000 years, it has always been gold. Let me now demonstrate something that actually altered my perspective on money. Flip a dollar-priced piece of gold. Ask how much gold $1 has bought over the past 50 years, rather than how many dollars an ounce of gold costs. Since 1970, the dollar's purchasing power in relation to gold has decreased by 99%. In the past 50 years, the dollar has briefly rallied against gold 4 times. 4, each one less powerful than the others. The chart has the appearance of a basement staircase. The target is 0 according to the annotation. Will it be 0 tomorrow? No. However, the course hasn't altered in half a century, not once. Additionally, many often interpret a bounce on the staircase as a trend reversal whenever the dollar has a strong week and gold falls. It isn't. In 50 years, it has never been. Thus, this chart comes to mind when I watch gold fall from 5,600 to 4,900 and people claim that the gold boom is over. I believe that data spanning roughly 50 years demonstrates the same tendency. For half a century, the dollar has risen, gold has fallen, people have panicked, the dollar has waned, gold has increased, and so on. Let me now discuss gold. Since everyone's attention is on how much gold plummeted, I'm going to tell you something about the crash that you won't hear on any other channel. No one is observing how quickly it bounced, and you can tell anything from that bounce. The price of gold was $4,400 at the time of this fall. Already, it has recovered to about $4,900. What form does it take on the chart? It resembles a coiled spring, to use technical terms. It is compressing between a ceiling and a floor that is constantly increasing. The arithmetic underlying the pattern suggests that the goal is about 5,900, and these patterns usually resolve with a big move. Additionally, that coincides with JP Morgan's 6,300 year-end prediction. Could it first drop? Of course! I'm keeping an eye on 4,500 as my purchase zone if it happens. The strongest buying during this crash occurred there. They were purchasing between $4,400 and $4,600 from central banks, sovereign money, and the type of purchasers that don't check their phones every 5 minutes. I believe that gold is a gift if it returns to that region. Here's what interests me, though. Gold bounced hard after hitting $4,400 during the crash. It didn't just sit there. It didn't gradually drop to $3,500 or $4,000. After touching $4,400, it returned to above $4,900 in a few of days. A bounce like that doesn't occur unless there is significant money waiting at that level. That gold was quickly taken by someone who needed it. I can infer from that $4,400 to $4,600 is genuine support. Proven, not theoretical. I also want to make things clear. The situation shifts if gold drops below $4,400 and remains there. I would be worried about that. No position is married to me. I'm keeping an eye on the levels and responding to the market's actions rather than my own desires. People lose money because they are blindly dedicated to a position. Being mistaken and safeguarding my capital is preferable to being obstinate and seeing it vanish. That's simply my perspective on this. However, this is my perspective on gold in a broader sense. Furthermore, I want to state up front that this is my own personal viewpoint. I predict that gold will reach between $6,500 and $7,000. Not next month, not tomorrow. However, the fundamental factors driving gold's rise, the central bank's purchase of the dollar, the deficit, and the geopolitical unrest are all here to stay. They are becoming more powerful. Furthermore, $6,500 to $7,000 over the next 12 to 24 months is not a pipe dream if JP Morgan is predicting $6,300 by year's end and the chart pattern indicates $5,900 as a short-term target. It is the natural progression of all that has previously taken place. However, and this is where most people make a mistake, your admission fee is crucial. Writing gold down to $7,000 after purchasing it at $5,500 represents a 27% gain. Not too awful. However, it is a 55% gain to buy gold at $4,500 and write it down to $7,000. Completely different result, same destination. I keep telling people to wait for the pullback because of this. Even if the theory is correct, you could still lose money if you try to raise the price. Reaching the proper accumulation levels of $4,000 to $4,500. In a bull market, that is the real way to accumulate riches. By purchasing the dips, not the rips. And we're in a downturn right now. Silver. Since silver is the metal I own the most of, this one is personal to me. 2. It was not enjoyable to watch it drop from 121 to 75. I support the long-term premise, but a 40% decline is a 40% drop. It puts your faith to the test. It causes you to doubt everything. Thinking about whether you should have sold at 80, 90, or 100 keeps you up at night. I understand. I've been there. I'm present. However, this is what I saw during the collision that caused me to pause and reflect. The silver price that you see on your screen, the paper price, fell apart. However, the actual market presented a different picture. In London, lease rates, which indicate how much demand there is for borrowing real silver, skyrocketed to 4.5%. That is excessive. Stress is that. This implies that even when the price was plummeting, those with actual money still required actual metal. In the first 6 days of February, 22.5 million ounces of COMEX were delivered. Physical silver was not being sold at the time of the crash. They were waiting for delivery, purchasing it. Right present, there is a discrepancy between the statements made by the physical market and the paper market. Sell, the paper says. Hold everything and give me more, urges the physical. In addition, the iShares Silver ETF SLV saw nearly $40 billion in trading volume in a single day during the crash. $40 billion. That trading volume surpasses the combined volume of Apple and Amazon. Compared to the two largest corporations on the planet, silver, a metal that most people associate with their grandmother, was exchanged more frequently. In a failing market, that doesn't occur. That is what occurs in a competitive market. One of these is incorrect, either the physical demand or the paper pricing, and typically, the physical market prevails, albeit not usually immediately, when the gap is this large. After tapping it and verifying that it is new support, it launches higher. It's textbook. Additionally, the breakout will be confirmed if silver retests between $50 and $60 and holds, which I think it will. Furthermore, a proven 50-year breakthrough does not signal a return to 80 or 90. The advance is to 130, 150, or perhaps higher, because anything above a 50-year-old ceiling is revalued by the market once it becomes a floor. My buy zone is 60 because of this. A retest of the breakout zone would be the ideal entry point for the following leg up, not because I believe silver will crash. And if the low is 75 and it doesn't return to 60, the breakout is considerably more powerful than I initially believed. In any case, the 50-year cap has been lifted, and the majority of people haven't even started to consider what that means for the upcoming years. Additionally, most people are unaware of another development involving silver. According to some rumors, the Chinese government might be becoming involved directly in a huge short position in silver. The CCP might be filling the void left by a trader named Bianaming, who was short on silver. Silver has turned into a geopolitical metal if it is managed by a national government. It is no longer merely a commodity. It is being regarded as a strategic resource by nations. And they're telling you to sell it because it's useless. And this is just becoming worse due to the current geopolitical environment. Better yet, depending on your stance on this trade, Taiwan just informed the U.S. that its demand to shift 40% of chip manufacturing to the U.S. is, quote, impossible. Taiwan may start thinking about deeper connections with China if the U.S. applies further pressure and imposes tariffs on Taiwanese semiconductors. A change in geopolitics like that causes gold to spike hundreds of dollars in value overnight. The Cuban public transportation system has reached a breaking point. Basic services cannot be maintained by the government. In actual life, currency collapse looks like that. I'm not saying that the U.S. is like Cuba. However, the same dynamics that destroyed their currency, deficit spending, money printing, and a lack of confidence, are still at work today everywhere. The distinction is that gold is insurance against the degree deteriorating. At the moment, every geopolitical headline points in the same direction. Not lower, but higher gold. Since many of you own mining equities, allow me to discuss them, and I am aware of how harsh the past several weeks have been. You could lose 40 or 50% if you purchased a junior miner close to the top. That is heartbreaking. Furthermore, I won't encourage you to simply wait and be patient because it's simple to say that when it's not your money. However, I have something to show you. And since this is the kind of stuff that most finance channels never show, I was unsure if I should put it in the film. It shows gold mining stocks over a 20-year period, starting in 2007, and comparing them to gold itself. This is what you see. For more than 10 years, mining stocks declined in relation to gold. The worst time in a generation to purchase mining stocks was from 2015 to 2020, when the market crashed and touched its lowest point, complete despair. And then they began to curve back up, gently, silently. What form they are taking, and I will explain it simply. It appears to be a huge U. 10 years of suffering on the left, a low point in the center, and an impending upturn on the right. When that U shape is finished, miners have typically outperformed gold for years rather than weeks. Additionally, the smaller exploration and development firms, known as junior miners, recently performed an action on the weekly chart that they haven't done in more than 10 years. On enormous volume, they burst over a barrier level that has held them back since 2013. Technical analysts wait their entire careers to witness a breakout like that. Does this imply that juniors will always win? No. Stocks in mining are erratic. Within a week, they can drop by 30%. Your emergency fund is not where they belong. You won't need the money in 6 months. I want to make that very clear. However, the current setup in miners is uncommon if you have a long-time horizon and are aware of the risk. From here, the major producers have a feasible route to increase by 40 to 50%. And if history is any indication, the juniors could perform several of those tasks. I must now address the elephant in the room before I conclude. According to the video's title, they want you to sell. Who are they? It's not a clandestine cabal. It's not a dimly lit room with a shadowy group. It's not that complicated. It is the market's actual structure. Physical gold or silver that is sold during a crash does not vanish. It is purchased by someone. Furthermore, retail investors are never the ones making purchases during crashes. Institutions are what they are. Central banks are what they are. They are funds of sovereign wealth. They are the world's largest, most understanding, and most patient buyers. They also require sellers. Panic is what they need. They want you to believe that the end of the world is near. Thus, you give them your metal at a reduced price. It includes the margin increases. Leverage traders are forced to sell when the exchange increases margin requirements during a crash. More panic results from more selling. More panic leads to more sales. Anyone who is unable to hold and is left standing at the end is intended to be flushed out by this cascade. Those with the longest time horizons and the largest financial resources. They profit from the recovery you missed and purchase what you sold. Their portfolio is your panic. If you sold, I won't hold it against you. In financial markets, fear is the most potent force, more potent than greed and more potent than reason. However, the data is unambiguous. Those who hold through crashes do better than those who sell them, each and every time. The United States deficit problem cannot be resolved, not in this government, not beneath the following one. During the best economic times we will probably see for years, the government is spending at crisis levels. They will never reduce spending if they are unable to do so now. And they don't, each year. Gold becomes more essential as the dollar depreciates. There is no end to this cycle. Similar to the 50-year chart I previously showed you, it is a staircase that is descending. What I'm going to say is that this crash hasn't altered the reasons I own precious metals. None of them. China continues to purchase. The dollar continues to decline. The deficit cannot yet be corrected. The physical market remains competitive. Nothing essential has changed. The price was the only thing that changed. Furthermore, it is not a catastrophe if the price is lower, but the thesis remains the same. It's a sale. However, you must decide that for yourself. I respect your decision if you believe the risk is too great. More crucial than any trade is safeguarding your mental well-being. However, don't sell because you were frightened by a headline. If a pundit who doesn't own a single ounce says the rally is over, don't sell. Don't let fear dictate your choice. They want you to sell is the title I gave this video, so ask yourself this. Why is the Chinese market still buying if the bull market was really over? Why are there more comics being delivered? The dollar is still dying, but why? What causes each geopolitical crisis to worsen? At least one of those would have been different if it had ended. Not one has. In this bull market, every crash has been followed by higher highs. I have no way of knowing if it will occur again. The setup, however, is in place. You have a choice, and the data is clear. If the video helped you think more clearly, please share it with someone who is currently experiencing fear. Because when people are alone with their fear and lack the information to support it, they make the worst financial decisions. Leave a comment below with your thoughts. Describe your actions to me. I read each and every one. The hidden economy is this. I'll see you in the upcoming